Continuing our MyLab problems for Chapter 17. Problem 8 is a comprehensive tax-deferred asset and tax-deferred liability problem, as well as a permanent tax problem. And so we're combining both permanent and temporary. So the goal here is to figure out the journal entry and the differences in the taxes, book versus income. So this company has the following information regarding its book tax differences. 1. Installment sales. The income recognized under GAAP on our books is $740,000. The income recognized under tax is only $90,000. So what you should be thinking right here is, under the tax, we're going to be reporting less income. So we're paying less tax now, which means we will have to pay more tax in later years, as this $740,000 actually gets paid in latter years. So if we're paying less tax now to be paid more tax later, that is a tax-deferred liability. The 2-year warranty cost of warranty expense is $75,000 in GAAP versus $65,000 in tax. Similar to installment sales, we can't recognize warranty expense for tax purposes unless it's actually paid. But under GAAP, we can accrue for it with the income or the revenue generated per GAAP. We can assign a warranty expense to that revenue. So let's talk this through. If we're deducting $75,000 in GAAP but only $65,000 in tax, from a tax standpoint, we're going to show more income because the expense is lower than under tax than GAAP. If we're going to report more income on a tax basis, so if we are deducting less expense on our tax return, we're going to show more income. Showing more income means we're going to pay more tax. If we're paying more tax now, that means we will pay less tax in the future, as the warranty expense that's higher under GAAP eventually gets paid out in latter years. That creates a deferred tax asset. Also keep in mind, it is a 2-year warranty cost. The 2-year is a giveaway. What that means is, because it's based on 2 years, the tax asset is going to have a current portion and a non-current, because the current is based on 12 months, 1 year, and the non-current is the following year. Let's look at depreciation expense. Under GAAP, we're deducting $82,500 in depreciation from our income, but under tax, we're accelerating it at $112,500. What does that mean? It means that we're deducting more depreciation expense off our income on the tax books. If we're deducting more expense from our income on the tax books, it means we're paying less income today, only to have to pay more income in future years. Again, that becomes a deferred tax liability. We're required here to prepare the journal entries for the tax provision for the current year, classify the deferred tax accounts on the balance sheet as of the end of the current year. So once again, to prepare that, you want to come up with the book basis for the installment sales, the warranty costs, and the building. To get to the book basis, you're simply taking the difference between the book basis and the tax basis and netting them. So in this case, 740,000 minus 90,000 is going to equal the 650,000 under the book basis. That 650,000 is a deferred tax liability times the income tax rate of 35%, which is given right here in the problem. So the 740 minus the 90 equals the 650. 650 times the 35% gives us a deferred tax liability of $227,500. Moving on to warranty costs, GAAP was $75,000, the tax was $65,000. So we had a $10,000 difference. But because this is a deferred tax asset, it's going to be positive. The $10,000 times the 35% tax rate gives us a $3,500 deferred tax asset. The building. The building is based on the following calculation. Take the building cost of $1,500,000 minus $82,500 for GAAP, which is the accumulated depreciation to get to the book value of the building, which is $1,417,500. Take the same cost of $1,500,000 under the tax purposes, subtract the accumulated depreciation on our tax books of $112,500. The book value under tax basis is $1,387,500. The taxable difference is $30,000. Multiplied by 35% gives us a deferred tax liability of $10,500. That's all you have to do to come up with your deferred tax asset and liability. Now to journalize this, it's simply take the income before book tax differences, which is given to you in the problem. That income is $990,000 in this problem. So where the book tax difference above is $990,000, you want to take your number, and that's your starting number. Now we begin to reconcile the difference between our GAAP books and our tax books. The installment sales income recognized is $740,000 GAAP, $90,000 tax, right from your data table. Your warranty costs subtracted from your income are $75,000 GAAP, $65,000 tax. Depreciation expenses deducted from GAAP income of $82,500. For tax purposes, $112,500. Therefore, your income before tax under GAAP is $1,572,500, and your income before tax or taxable income on the tax side is $902,500. These two numbers will get the 35% tax rate that's given to you in your problem. So you want to take the $1,572,500, multiply that by 35% to get your tax expense of $550,375. Again, your income tax expense is the GAAP income before tax multiplied by the tax rate. To get to your income tax payable, you're using the tax books. The $902,500 times the 35% tax rate equals $315,875 as your taxes payable. The difference between the income tax expense and the income tax payable is a combination of your deferred tax asset and liabilities. These two numbers are right here in your worksheet. So the liabilities are the $227,500 plus the $10,500 gives you a liability of $238,000, and your deferred tax asset is $3,500. Finally, they want to know what's current portion on the balance sheet and what's non-current. The current portion is going to be $227,500 for the installment sales, and that's right from your schedule right here. Half of the warranty cost of $3,500 because it's a 2-year warranty program. So the first 12 months is current, and then the next 12 months is non-current. So just split that in half. The building of $10,500 is non-current because it's a long-term asset. And that's how you would present it on the balance sheet. So to quickly review, you take the difference between your GAAP and your tax and put it under the book basis. But on the building, you want to take the building cost of $1,500,000 and subtract the depreciation accumulated. You get your tax differences in this column, extend the tax rate to determine your deferred tax asset and liability. Again, your deferred tax asset is going to be based on your warranty costs. Your deferred tax liability is going to be your installment sales and depreciation expense. Then build your income statement for GAAP and tax pay purposes. The $990,000 starting point is given to you in the problem. Take your installment sales for GAAP and tax, your warranty costs, subtracted that from your income for GAAP and tax, and your depreciation expense to get income before tax and taxable income. Multiplied by the 35% rate gives you your income tax expense on the GAAP side. The tax multiplied by 35% gives you income tax payable. Then simply take your liabilities in this schedule, $227,500 and $10,500, to give you your deferred tax liability, and your deferred tax asset is from the same schedule right here. Installment sales receivable are current. Half of the estimated warranty liability is current because it's a 2-year warranty. The non-current portion is the other 12 months remaining on the 2-year estimated warranty liability, and the plant and equipment, which is long-term asset. So hopefully this helps you get through this solution without too much struggle. It is a little more complex because it combines several different types of tax-deferred asset and liabilities. Problem 9. The following information is from the financial statements of the Centers Product Group for the first 3 years of its operations. So it gives us 3 years of financial statements for GAAP and tax for years 1, 2, and 3. So let's go through these items. You'll see that revenue from product sales are the same for both GAAP and tax. Revenue from subscriptions is different for GAAP and tax. So we are recognizing revenue on GAAP purposes, but not on tax. We're going to have to determine if that's permanent or temporary. Cash collected on subscriptions, again, not recognized for GAAP, but recognized on tax. So it's obviously related to the revenue from subscriptions. Revenue from subscriptions for GAAP purposes is obviously earned temporarily put on the unearned on the balance sheet and then earned as the subscriptions come due. But for tax purposes, we don't have to recognize it unless cash is paid. So not only do we have to determine if it's temporary or permanent, we have to determine if it's a deferred tax asset or liability. Installment sales, same treatment. We get to recognize it as a sale for GAAP only until it's paid. For tax purposes, in cash can we recognize it, which is right below here. And then tax-free interest income, which is municipal bonds, as we learned, is definitely a permanent difference. We have to recognize that as income for tax purposes, GAAP purposes, but not for tax purposes. So we get a difference in total revenues. Cost of sales are not the same for GAAP or tax, which indicates that we have a inventory difference in the way we recognize our cost of sales for GAAP or inventory. Okay, so that could be a LIFO or FIFO issue. You're familiar with estimated warranty, which gets accrued for GAAP purposes, but only recognized when the repairs are actually done, which is the line right below. So those are temporary tax differences. Operating expenses are recognized equally under GAAP or tax, so that's not an issue. Insurance expense, we get to deduct that for GAAP, but we can't for tax purposes. So that's going to be a permanent tax difference. Depreciation expense, as you've already know and are familiar with, is based on the accelerated method for tax purposes compared to the straight line method used for GAAP purposes. Again, that's going to be a temporary tax difference. The total income before tax is going to be the $242,000, the $103,000, $230,000. These numbers here, income before tax, multiplied by the 40% tax rate, which the problem doesn't show you, but the income before tax under GAAP multiplied by the 40% tax rate is going to give you your income tax expense for the year. The income tax payable is going to be the taxable income determined by the tax income statement, which is total revenues minus total expense gives you $47,000. Total revenues minus total expense gives you the $103,000. Multiply that by the 40%, and that gives you your tax payable. So the requirements: identify all book tax differences and classify each difference as temporary or permanent. Prepare the footnote in percentages in dollars to reconcile the federal tax rate to its effective tax rate. Determine the net income reported on the income statement for each year, which should be fairly simple. So, let's look at our solution for A first. Identify all the book tax differences. So under A, cost of sales is your first book tax difference, which is temporary, possibly using FIFO for GAAP and average cost for tax. Depreciation is temporary, straight line versus accelerated. Installment sales is temporary, accrual basis versus cash basis. Officer's life insurance is permanent, not deductible for tax purposes. Subscription sales are temporary, accrual basis versus cash. Tax-free interest is permanent. That's income recognized for GAAP, but exempt for tax purposes. Warranty costs are temporary, again, accrual versus cash. Prepare the footnote in percentages of dollars. So, income tax at the statutory rate of $96,800, $41,200, $92,000. So, where do those numbers come from? Again, they come from simply taking your 242,000, multiplying it by 40%, which is 96,800. Do that for each year. Which is done for you here in this solution. So take the income before tax on the GAAP side, multiply it by the statutory tax rate to get income tax at statutory rate. Subtract the tax-free interest and take the officer's life insurance. These are your permanent tax differences to get to your effective tax rate. And take the 86,800, and that's going. These percentages are going to be based on your revenue. So if you go to the solution here, you're going to see that the effective tax rate is income before taxes of 242,000, which is the 7.93, and the officer's life insurance of 242,000. You're going to do the same for year 2 and 3. You're going to use 103,000 as your base and 230,000 as your base for year 3, as they show you here. So as a percent of revenue, that's what they're looking for. And so your effective tax rate is lower than your statutory tax rate. Determine net income reported on an income statement for each year. Very simple. You take your income before taxes under GAAP. You subtract your income tax expense, which is computed in the schedule right above it, to get net income after tax. And that's all you really need to do with that solution. Probably the hardest part here is not getting temporary and permanent confused, and knowing that your footnotes, your statutory versus effective tax rate, only deals with permanent differences in taxes, not the temporary.